UK banks are cracking down on cryptocurrency, but money laundering regulations are the real issue. NatWest, the UK retail bank, has announced that it will no longer work with business customers who accept Bitcoin or other cryptocurrencies as payment. It comes on the heels of HSBC's recent announcements that it will not accept transfers from digital wallets and will not allow customers to purchase shares in companies associated with cryptocurrencies, such as Coinbase or MicroStrategy. Both banks believe that cryptocurrencies are high risk and thus warrant a cautious approach, though they caution that their position may change if and when regulation changes. Surprisingly, this is not a viewpoint shared by institutions on both sides of the Atlantic. Morgan Stanley and Goldman Sachs are now allowing their wealth management clients to invest in Bitcoin. Indeed, initial interest has been strong, with Morgan Stanley alone attracting nearly $30 million, £22 million, in 2 weeks. Why the apprehension? NatWest and HSBC's cautious approach stems from the 2012 recommendations of the Financial Action Task Force, a G7 initiative aimed at combating money laundering. These recommendations require each member state to put in place measures that require banks to scrutinize customer transactions for the purposes of money laundering and terrorist financing. The anti-money laundering framework should be applied based on perceived risk, according to Recommendation 1. In other words, if a transaction or business activity is perceived to be more risky than usual, the bank must conduct a closer examination to ensure compliance with the framework. This puts more strain on bank resources to verify that a transaction or business activity is safe to continue, but they also face large fines for non-compliance where there are flaws in the framework's implementation or if things go wrong. NatWest and HSBC are no strangers to being scrutinized for regulatory violations. In 2012, US authorities fined HSBC $1.9 billion, while NatWest is facing charges in the UK for significant compliance violations. While these charges are for traditional money laundering compliance violations, they may help to explain the two banks' caution. Banks consider digital currencies risky because they can be used for money laundering, are targets for fraud and scams, and their value can be extremely volatile in the short term. Indeed, the UK's Financial Conduct Authority has warned that those who invest in and trade in cryptocurrency risk losing all of their money. Rather than bear the increased burden of investigating businesses and individuals dealing with these assets, banks can avoid the risk and avoid engaging with them. This is not a situation unique to cryptocurrencies. Banks, for example, have long refused to provide financial services to charities operating in high-risk jurisdictions as a result of anti-money laundering regulations. The banking industry accepts this reality, especially given that charities are typically low-value customers. Is this the wrong approach? On the surface, banks have every right not to provide financial services to businesses that use digital currencies. Banks must adhere to anti-money laundering, anti-fraud, and consumer protection regulations in addition to anti-money laundering regulations. Because fraudulent crypto transactions are difficult to detect and impossible to reverse, the risks of participating are high, at least until the market matures and the business case for participation becomes stronger. Of course, this is not to say that they have always made the correct decision. The fact that the top US banks have taken a different approach indicates that they believe the potential rewards outweigh the compliance burden. In their defense, cryptocurrencies are more traceable than cash and are used less for money laundering. We could blame the UK banks for being too cautious or not doing enough to assist these businesses, but this ignores the larger design flaw in the anti-money laundering framework. When a transaction or business is deemed high risk, compliance measures are a significant drain on a bank's resources. Banks and their employees are also subject to criminal penalties, including large fines, if they fail to properly implement the rules, which is especially difficult when it is nearly impossible for a bank to identify what a suspicious crypto transaction looks like. Without a guaranteed high return, it is easier for the bank to de-risk and avoid engaging in these businesses. This is a missed opportunity for banks, as well as a potentially unnecessary stifling of legitimate business growth for companies interested in dealing with cryptocurrencies. Banks are portrayed as the public villain, but the larger issue is much more serious. It is a political and legal issue that requires lawmakers' attention and intervention to address the fact that it is much easier for banks to de-risk than it is to comply with the rules and assist these businesses in growing.